And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. A new year, lots of new money moving around the ETF space in the first month of the year. Let's find out where the money is going with Ben Slavin. He's the global head of ETFs at BNY Mellon. Todd Rosenbluth is the head of research at Verify. Ben, I got, of course, spot Bitcoin ETF. It happened. It looks successful. We've been talking about it. It looks like it's tracking all of them fairly well. Is that the case? And tell me about the flows. What strikes me as interesting is we're getting nice flows, but a lot of it seems to be coming out of the existing grayscale into the 9 new ones that are out there. Just characterize how the trading looks.
First of all, from an infrastructure perspective, we are providing a large degree of the services to these products. So we look across the whole industry. And what I can tell you is, or the headline being, they're working as advertised. They're doing what they're supposed to do. They're tracking. And we also see a healthy market in terms of liquidity, depth, spread, and obviously interest from investors. But to your point, it is interesting to look at the flows and try to unpack what's really going on there. And what we see is, yes, there's money coming out of GBTC and on a net basis into the rest of the products. But a lot of that money seems to be institutional investors versus retail investors who really haven't jumped into these products yet, at least en masse. They're not on models. They're not available even on some of the platforms. So, again, our suspicion and the data seems to indicate it's more the institutional investors playing here.
And, Todd, why is that? I mean, I see numbers something like $4 billion in inflows into the new ones, but most of that seems to be money coming out of grayscale. How would you characterize this? I mean, it's $4 billion in inflows is still nice to see, but most of it coming out of an existing product, to me, tells me there's not a lot of necessarily new outside money coming in. Is that a fair characterization?
I don't think it's fully fair. I think we're seeing people who moved into GBTC, the grayscale product, heading into an approval process for the broader efforts, knowing that the price of Bitcoin was likely to go up. And so there's some profit taking that's happening. But we are seeing money go into the BlackRock product. We're seeing money go into Bitwise. ARK itself is buying the product that they have, ARKB. And what we're finding out is still early in education days. We at Verify hosted a crypto symposium the day after it launched. And what we heard from advisors are they're looking to buy in the next 3 to 6 months. Yeah. So not everybody was ready to go right away. They're still getting up to speed from an educational perspective.
But Ben brought up a good point. These aren't on a lot of platforms, right? I mean, Vanguard made a statement. It's not going to be on our platform. But if, for example, is it on Fidelity? Is it on JP Morgan? Is it on Morgan? Is it on Merrill Lynch's platform? Has anybody actually, I haven't made the phone calls. I'm curious myself.
So the wirehouses have not approved it. They all have some level of gatekeeping. An ETF needs to be either $100 million in assets under management, and now we have those products. I think 5 of them are more than $100 million plus GBTC. But it also is a 6-month threshold. An ETF has to trade for a period of time. But advisors that clear through Schwab, or what used to be TD Ameritrade, advisors that clear through Fidelity, some of the other independent broker-dealers, you can buy it. And, of course, self-directed investors on most of that platforms can too. It's just still very early from an educational perspective.
Yeah. You made an interesting point. You said that you do a large degree of services in the ETF business. I want you to explain that, because one of the reasons I have you on is Mellon is not just a person. You guys don't just have ETFs. You have a giant ETF business. I call you guys the plumbers of the ETF business. You run a lot of the stuff underneath the surface, like calculating net asset values, for example.
Exactly.
Explain what BNY Mellon does, why you are sort of the plumber for the ETF business. What do you do?
Yeah, as you said, we play a huge role as part of the total market structure, providing really a lot of the infrastructure that powers the entire ETF industry. So we are the largest and oldest player there in that space, and we do provide services ranging from accounting, calculating the net asset value, financial statements, all the administration, and also custody, which is the clearing and settlement of trades. And on top of that, we are the front lines, the order taker, processing every dollar that comes through our clients' ETFs via our proprietary ETF technology, placing all the creation and redemption orders across the entire book of the ETF.
That always fascinates me. Like, just calculating the net asset value is such an important function, and yet, it's important for somebody like you guys to calculate for other people. Do mutual funds outsource the calculation of net asset values?
It's pretty much the same in terms of the services. What's unique for ETFs is really the ETF services. It's the creation redemption mechanism that's unique. And all the services that are attached to that are really different for ETFs. But a lot of the net asset value administration services are common across pretty much any pooled investment vehicle.
And you said you serve a custodial function for a lot of this, not for Bitcoin, though, mostly, right? Coinbase is the custodian for most of them. Right?
Exactly. So there are a few exceptions, and Bitcoin ETFs are one of them. So we provide all of those services to the Bitcoin products, except for custody, which, as you said, Coinbase does provide the actual custody of the Bitcoin for most of the products that are out there.
Todd, there's a lot of buzz in the ETF world about emerging alternatives to the Magnificent Seven stocks. Everybody's looking. The tech sector is what, 30% of the S&P 500 now? Semiconductors are a quarter of the tech sector. So I see people looking at the equal weight RSP. I see inflows there. I see the equal weight tech ETF as well. There's equal weight everything, folks, including sector breakdowns. That got significant inflows, the tech equal weight tech ETF. Are investors getting nervous about how top-heavy tech has become? That seems to be the message when I look at the flows here, but what are your thoughts?
Yeah, so investors are getting nervous that too much money is concentrated in a handful of stocks within the broader ETFs that they have available tied to the S&P 500 or even NASDAQ 100. So you're right. The Invesco suite of equal weight products, RSP is the equal weight S&P 500, RSPT is the equal weight technology sector.
RSPT is the equal weight tech. Thank you.
Right, and so those ETFs, you spread that risk around. So you own the same companies that you'd find within the S&P 500 or in the technology sector, but instead of it being dominated by Apple and Microsoft and NVIDIA, you spread that risk around to the other companies. We're also seeing greater interest in actively managed ETFs. In fact, at the Exchange Conference that you're going to be at with me and Ben in a couple of weeks, we are having a session on how to get exposure to equities outside of the Magnificent Seven. And we have T. Rowe Price and Morgan Stanley that are going to be joining us to talk about that and how you can use those ETFs to spread that risk.
And so is it a fair interpretation, Ben, to say that the flows sort of imply, the flows into these equal weight products imply some nervousness about the top heaviness of tech? I keep asking because it's always difficult interpreting what flows really mean. Right. People ask me all the time, oh my gosh, well, this seems to be a logical explanation for why they're getting flows at this point. And yet, you can make an argument. NVIDIA is big because of what it does and what it has managed to capture in the AI space for a reason. So market cap weighted, products work because it's a voting mechanism. And the public has voted that NVIDIA is going to be a huge share of the AI business that's motivating this. So it's not like it doesn't matter, market cap weighted indexes. You can be top heavy for a reason. Right. I'm trying to argue both sides here, right? This is what's annoying about this.
Look, you could see a little bit of both, right? And I'm going to argue a little bit of both sides as well. When you look at the flows and what we've been seeing this year is certainly there is more money being allocated there. Obviously, there's momentum, and you're seeing, not only the broad-based, S&P 500, et cetera, traditional ETFs get money, but also the tech sector products as well, and certainly semis and those that play that theme are clearly attracting investor attention. But you step back and you see the flows are pretty sluggish, really, to start the year. And you see some signs of where some of that money is starting to go to come off the sidelines. And you look at things like small caps that had a big rally in the fourth quarter, still getting some traction. And then you're seeing some sectors that have been less loved, at least less loved last year, like financials, even a little bit of real estate, some industrials that are starting to pick up some money. And you're starting to see a picture, and again, in our conversations with advisors, are looking for somewhere else to go and are starting to get nervous based on valuations. Here we go.
The problem I have with the equal weighting is it goes against the weight of history, because we know that basically there are a few winners and mostly everything is sideways to down when you look out past 1 year or so. You can get rallies where everything moves up, but in the long run, we did this study last year. I talked about 64,000 stocks over 30 years studied, and 2% of them account for most of the gains that you see. And so the problem I have with equal weighting is the weight of history argues generally against the idea that the market always goes up equally.
But if that's the case, do you know which of those companies are going to be the winners?
No.
So if you don't, then you want to spread that risk around, and you own just as much of everything within the broader portfolio. And so if it isn't Apple and Microsoft that's going to lead the market higher or be the winners going forward, then you'll have enough exposure to it. And so that's the benefits of equal weighting to me.
We've had covered call ETFs were hot last year. JEPI was huge. Actively managed core ETFs were still big as well. So I don't know. The public, it's hard for me to say that there's a really clear trend right now. I do see money going into equal weight, but it's not an overwhelming amount of money.
No.
It's noticeable. You can see it, but it's not overwhelming. I want to move on and talk about bonds. There's been some signs ETF bond investors are moving out of the short end of the curve. Maybe you can weigh on this a little. Can you explain why they would be moving out on the short end and what that might imply? Where would they be moving into? Longer end?
It certainly was the story of 2023. You saw a lot of money go into that short end of the curve. These are the ultra short or short-term government ETFs. Certainly money market funds was a huge story. But also we saw a little bit of a change really in the fourth quarter and into this year, where we saw a lot of money start to move out of that short end of the curve into intermediate duration. And you started to see that picture start to emerge where advisors are looking and retail investors are looking to capture or lock in those higher yields and also potentially get some capital appreciation as rates back up. And, they could look to profit as the Fed, starts to ease, assuming, you're anticipating that happening at some point later on this year. And we're starting to see that show up in the pictures and the data that we're looking to see.
So, Todd, is there an argument that can be made? Is there a fixed income discussion as to whether is the market too optimistic about Fed rate cuts and the timing? A lot of advisors have told us they're expecting just 2 or 3 rate cuts. So the consensus is 4 to 6, depending on who you ask. What's it telling us? Is there anything we can see here that the market's telling us?
So that's what's surprising to us. We survey advisors at Verify on an ongoing basis during our webcast, and we ask them what do they expect in 2024 in terms of the number of rate cuts. You're right. The Fed has put out some guidance. The market overall has been talking about 4 to 6. We actually saw the majority of advisors that told us at Verify they're looking for 1 or 2 rate cuts in 2024. So that argues that you should stay relatively short term if you're not going to get rewarded in intermediate term products.
So the point is if the Fed cut rates 6 times in 2024, the longer end would benefit more.
Correct. So TLT is the iShares 20-plus year Treasury ETF. That will get the biggest bang for its buck. Some of the intermediate-term products like VCIT will get some bang for the buck, and the short-term products that were very popular in 2024 will largely tread water or earn a little bit more than their overall income. If we get fewer cuts than the market is expecting, and that even that the Fed is originally guiding to, then you're not getting rewarded for that. You're actually just taking on more risk. Nobody in fixed income wants to take on more risk than they feel is necessary.
Well, I would just add, TLT, which is that 20-plus year duration ETF, Treasury ETF, really was a top flow getter in 2023, even though for the vast majority of that year it was unprofitable. And so you saw a lot of that, positioning start to, occur. But I think a lot of the, investors that we talk to are worried about the reinvestment risk. So Todd's exactly right. You do get, it will tread water or close to it in that environment, but you really have that reinvestment risk if the Fed cuts rates as those yields trend down. And so investors are looking for a way to, capture that or lock in those higher yields.
I can't tell you how many people just message me. I'm perfectly happy in my money market fund, which is still pulling, 4%?
Yeah.
Still?
With no risk, or essentially no risk.
Well, the risk is if it moves quickly, you're not going to get 4%.
Right.
There's no, 1 year from now we're going to get 4% on anything. But they seem very happy with this. I keep telling people, you think that this is something you've signed on to for the rest of your life, and you have not a clue that this could be 3 months from now. This could be 2%.
Right.
Exactly.
And they don't seem to be. That kind of risk doesn't seem to occur to them. That's there. There's no, there's no real. You're not locking in anything when you do that.
Right. It's not a 1 year CD or 1 year T-bill ETF.
And I'm kind of surprised people do that, because if you want to lock it in more, a 2-year CD is a much better instrument, because you know what you're going to be getting for the next 2 years. They're telling you what you're going to be getting. You have no idea what you're going to be getting in a money market fund, and yet people seem delighted by this.
And not even just the 2-year CDs. We have these products that came from bond blocks and FM that offer you exposure to the single treasury and now even the corporate products with a fixed time horizon as well.
Elsewhere, I see inflows into quality. This is a phrase that I think is vastly overused. Quality basically refers to companies that have strong cash flow, growing their earnings, strong balance sheet. We've used these phrases for 30 years. The academic literature generally indicates that that is one of the factors that tends to outperform. You know, people talk about small cap tends to outperform big cap. Different sizes, small cap tends to outperform big cap overall. Value tends to outperform growth. Quality tends to do a little bit. These are one of these factors that we've seen. So QUAL has had inflows recently. There's a cash flow ETF, the cows, that's been doing very well. There's a small cap version of that, CAF.
Love the tickers.
CALF, yeah. That's small cap stocks with strong cash flow, right?
Correct. So small cap quality. We're seeing continued interest in these higher quality investments due to market uncertainty, due to earnings uncertainty going forward. And we've seen those products continue to be popular, even though we've seen new competition. Victory Shares launched V-Flow and S-Flow in the last 6 months. We've seen Amplify offer some of these products as well. This is a hot area to launch products and also to invest in the ETF space.
Quality makes perfect sense to me, because in a sense, that's what you want. You want a company with a strong balance sheet, growing earnings, good cash flow. All of this makes perfect sense. And yet, people still chase the moon. They still chase silly ideas and crazy little ventures, or companies that don't make any money, and small tech startups that are a long way from making money.
That's exactly right. I mean, quality from a marketing standpoint is exactly what you want and makes a ton of sense. But again, you see the flow picture.
Is it because it's boring? It's basically boring, right? It's sort of like...
I think you could widen that out and say it's really passive to some degree in general. It's boring, but it works. I mean, if you look at even a product in the tech space like, the QQQ, right? That product has been, pretty much a world beater from a performance standpoint. In that space, it is pretty boring relative to other options, but it works. But you still see investors, attracted to some other thematics, active, and some other more narrow slices of the industry, despite the numbers.
All right, guys, we're going to have to leave it there. Appreciate it. Always good talking with you. That does it for this week's ETF Edge. My thanks to Ben and Todd. Now, we've asked Todd to stick around and give us his perspective on the upcoming ETF Exchange Conference. That's going to be in Miami Beach, February 10th, Super Bowl weekend, folks. I'll be there. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.